evening, everyone. Welcome to our program. A big thanks to each and everyone for joining here with us. Hearty welcome to our resource persons, dear faculties, colleague friends, and student friends. It's my pleasure to extend a cheerful welcome to you all. Your presence makes us very happy. We are here, fifth day of our 6-day national level faculty development program on awareness on stock market. This person, Nagarajan sir and Dr. Karthika ma'am is going to explain about the topic of impact of corporate actions on a bonds, stock split, and dividends. I hope that today's session will inspire us as usual as the past 4 days were. Once again, welcome you one and all. Thank you. Sir?
Yes, ma'am. Thank you, ma'am. Thank you so much. Dear participants, good evening to one and all. I hope everyone are safe and good. And I'm going to start today's session. So, as usual, myself and Karthika ma'am is going to discuss about various aspects of 3 important corporate actions, namely bonus, dividend, and stock split. Ma'am, before I'm going to explain all these slides, I would like to check whether my voice is clear and presentation visible.
Yes, sir. It's clearly audible and visible also.
Okay. Thank you, ma'am. Thank you so much. And today I'm going to cover the 2 aspects. One is bonus issue and another one is stock split. So remaining things will be covered by Karthika ma'am. So straight away I'm going to my presentation. So I'm going to tell you what are all the things that I've covered or I'm going to cover in the area of bonus issue. So first I'm going to talk about what is the bonus issue, so that we will try to understand what is bonus issue actually and how the process of bonus issue will start by the company. So this is my first explanation. So after that, I'll give you an example. So that example is a live example so that you will be able to understand how bonus issue is creating wealth for the investors. So that in that perspective, I'm going to give you an example. So after that, I'm going to talk on taxation for bonus issues because this is very, very important. So I'm not going to talk to you about all the aspects of the taxation since it is a very bigger topic. So I'm not having that much knowledge to explain all the aspects of the bonus issue, but I'll try to tell you how we have to calculate the tax for the bonus issue. So these are the areas I'm going to cover with respect to bonus issue. So after that, I'm going to tell you about the difference between stock split and bonus issue and how bonus issue is creating impact and how stock split is creating impact, why we go for the bonus issue, which means why companies are going for the bonus issue and why the companies are going for the stock split. These are the things we are going to discuss for the 45 minutes. So from the basic, so we all know bonus shares will be issued by the companies for the existing shareholders. So if you have a share on that particular company, as on the record date, you are eligible to get a bonus share. Let's say for an example, now I would like to explain what is record date. So this is a date, this is a cutoff date I can say. So this is a cutoff date. So this date ma'am, anyone please, ma'am, sir, anyone please kindly confirm me whether my voice is clear?
Sometimes it's breaking, sir.
Now it's clear, sir.
It's clear, sir, now.
Okay. Wait. ma'am. I'll take few minutes to correct it. Wait a minute, ma'am. Sorry, participants. So, I think now my voice is clear, right?
Yes, sir, it is clear, sir.
Yes, ma'am. Okay. So, bonus issue is only for the existing shareholders. How they are determining that this person is eligible for the bonus issue, or this particular investor is eligible for the bonus issue. So they are going to decide based on the concept called record date. So based on this record date is a cutoff date. So if you have shares of that particular company as on record date, your demat account, you are eligible to get a bonus share. So this is the primary information with regard to the bonus share. I'll give you one simple example so that you will be able to understand how you are getting eligibility for the bonus issue. Here I'm saying that record date is going to be 30/8/2021. So this is the record date. So for the company named as Infosys. Okay, so they are imagine that they are coming up with the bonus issue of 1:1. Presently, you are holding the quantity of 100 shares. So you will get, or if you would like to participate in this particular bonus issue, you have to buy the, or you have to have the shares of the Infosys before 30/8/2021. So if you have that, if you have the shares in your demat account before 30/8/2021, you will get eligibility to participate in the bonus issue. So this is an important and fundamental thing about bonus issue. So here they have given the example also. So in this example, you can able to understand how you are getting the benefit of the bonus share. Say for an example, if your company is saying that, or a company which you are presently holding the share is saying that they are going to coming up with the bonus issue of 2:1, which means you will get 2 shares for the 1 share held. So this is the meaning of the bonus issue, or the ratio. We can say this as the bonus ratio. So bonus ratio. So based on this, we will calculate how many number of shares we are going to have after completion of the bonus issue. So in this example, you know that we have 3 shares after completion of the bonus share. Okay, so this is an important one. And second important point is bonus issue is at free of cost. There is no need to pay even a single rupee for a bonus issue. Okay, there is no need to pay a single rupee for a bonus issue. Why? Because company is giving you at free of cost. And you can ask now, if company is giving to me at free of cost, where the company is getting funded, or where company is financed for that? So this is another important question. So that will be clarified in the further points. So the company is taking reserves and surpluses. So say for example, if a company is earning a profit, that profit will be distributed to the shareholders in a ratio. That may be in the form of dividend, that may be in the form of bonus share, etc. These are all the various ways how company is trying to share the profit that they have generated over a period of time, normally within 1 year period. So, wait a minute, ma'am, I will check again. Okay. Okay. So, okay. So normally the retained earnings, which means profit generated by the company, will be distributed to the investors in the form of dividend or in the form of bonus issue. So if they are going for the bonus issue, they will take money from the reserves and surplus, and they will try to convert that money into bonus shares, and they will again send it to the again give it to the people at free of cost. So there are three important points we have to note down with regard to bonus issue. First one, bonus issue is only for the existing shareholders. To get eligibility for the bonus issue, you have to have the shares in your demat account as on the record date. If you are not having the shares in your demat account as on the record date, you are not getting eligibility to get the benefit of the bonus issue or to get the bonus share. And where you are getting, which means a company is giving you a share at free of cost. If a company is issuing a share at free of cost, where the company has get fund or where this particular bonus shares are funded, from where they are getting the fund, they are getting the fund from the reserves and surplus of the company. That will be converted into bonus shares, and that will be given to the existing shareholders instead of dividend like that. Okay, so this is another important perspective with regard to the bonus share. And I'm going to tell you the impact of the bonus share. So I'm just close this presentation, and I'm going to share a whiteboard to you so that you will able to get the example in a better manner. So I'll yeah, I think you are able to view my white screen, correct, ma'am? Anyone please kindly clarify?
Yes, sir.
Okay, thank you. And here I'm going to talk about a live example so that you will able to understand how bonus issue is going to be creating the wealth for the investors. So please kindly follow this example carefully so that you will able to understand, and you can also focus on the companies which are able to giving the bonus shares continuously or frequently. Okay, so based on this example, you will able to understand the concept clearly. So I'm going to take a company called Infosys. Okay, Infosys. So Infosys has came with the IPO. Infosys has came with the IPO. Sorry, in the year 1993. When they are coming, when they came with the IPO, right? So at that point of time, they have the share price at 95 rupees. Okay, so imagine that you're just investing 950 rupees and you bought 10 shares of Infosys. 10 shares of Infosys in the year 1993. We will try to check how or what is the value of those shares as on date. Okay, why? Because why I have selected this company. So Infosys is the one company which has issued, which has came up with the bonus issue so many times. So from 1993, from 1993 to 2018, from 1993 to 2018, Infosys has came with the bonus issue of 8 times. Okay, bonus issue of 8 times. We will see the example and we will try to know what is going to be the value of the Infosys today if you held 10 shares in the year 1993. Okay, so first I'm starting with the first bonus issue. So first bonus issue was in the year 1994. The bonus ratio is 1:1. And number of shares. If you are in our example, we have taken 10 shares. Okay, so what is the bonus ratio? Bonus ratio is 1:1. So 10 plus 10. So how many I'm getting? 20 shares. Okay, so in the year 1993, I have invested in Infosys rupees 950 for buying 10 shares. So in 1994, Infosys has came with the bonus issue 1:1 ratio. Now my 10 shares has came to 20. Okay, and in the year 1997, again they are coming up with the bonus issue. The ratio of the bonus issue is 1:1. So my 20 shares is going to be 40. Okay, so third time Infosys again coming in up with the bonus issue in the year 1999. The ratio of bonus ratio 1:1. So now number of shares becomes 80. Okay, so fourth time in the year 2004 they again came with the bonus issue. So ratio 3:1. So now I'm getting 240. So 3 times of 80, 240 plus 80. So totally, my total number of shares is going to be 320. And fifth time in the year 2006, they came with the bonus issue with the ratio of 1:1. So 320 has become 640 shares. And in the year 2014, okay, in the year 2014, they have again came up with the bonus issue 1:1. So now 1,280 shares. Okay, so in the seventh time, in the year 2016, sorry, 15, they have again came up with the bonus issue 1:1. So now 10 shares has become 2,560, and eighth time 1:1 ratio. So now 2,560 has become 5,120. Okay, so as on date, you have 5,120 shares. So just we will take the share price of Infosys today. So approximately the share price of Infosys today is 1,652 rupees. Okay, 52 rupees. So if it is so, your value has become 84 lakhs 58,240 rupees. So this is the impact of the bonus share, or how bonus share is creating the wealth. And here I would like to recollect one more important point that has been asked as a question in the first session, that session was handled by myself and Karthika ma'am. One of the participant named as Nishant, that particular person has asked that why there is a bigger response for the Zomato's IPO. Okay, so this is going to be going to be like Infosys in Infosys after 30 to 40 years of time. Maybe I don't know exactly, but this may be the this particular industry is having the possibility to boom in days to come. So this is the impact of the bonus share. So now I'm going to tell you how I'm going to select the company, on what basis I'm going to select the company, so that which means I would like to get some capital appreciation from the market value increase or increase of the share price. At the same time, I'm also looking at the ways and means of appreciating my capital by the way of bonus issue. If it is so, how I'm going to select a company? Okay, so there are some parameters. Based on that, you can able to select the company. So there are 4 to 5 parameters. Based on that, you can select a company. So first important parameter is profit. So a company is generating the profit over a period of time. So you have to check whether the company is getting the, or whether the company is able to generate the profit consistently over the period of 5 years. So this is the first criteria you have to check. So first criteria to filter or to focus the companies which is possible to give the bonus issue. So first you have to check the profitability of the company. So this must be consistent and this must be at least for the period of 5 years. So this is the first criteria. Second, what you can do means you can do an analysis on reserves and surpluses. So how the company has utilized the reserves. So reserves can be utilized in 2 or 3 forms. So they can use the reserves for dividend. This is the one way they can use the reserves. And second one, expansion. So don't focus on the companies which are retaining the profit for the purpose of expansion. As we know very well that we faculty members are teaching the concept of cost of capital, right? In cost of capital, we are taking the three to four important sources. So first source is cost of equity, second source cost of preference shares or preference capital, and third one cost of debt, and fourth one cost of retained earnings. So here retained earnings is the one which is utilized by the organization for the purpose of the expansion. Say for an example, if you take Microsoft. So Microsoft is the organization. That organization is not having the bonus history as like Infosys. Why? Because the Microsoft has utilized all its profits or the retained earnings for the purpose of expanding its operations. So if you are focusing on the company which is using the retained earnings for the purpose of expansion, so at that point of time, they will not able to issue the bonus shares. Okay, so this is the point number one. And one more important thing, if you are choosing the company which is continuously using the retained earnings for expansion purpose, that will definitely help you to identify the company, whether this company is going to go for the bonus issue or not. Why? Because whenever the money that has been retained by the company as a resource that has been utilized by the company for expansion, then there is no money for them to give or to issue the bonus share or to give the dividend. Okay, so don't focus on the companies which are used the retained earnings for expansion purposes. This is the one important thing. And you can also focus on these companies. Why I am telling you? Because whenever a company is able to utilize the retained earnings for its expansion, whenever a business operations of the company expanded, that will again increasing the profitability of the company. Whenever profitability of the company increases, that will definitely increasing the value of the share in the market. So you can look at in either ways. Okay, but this is another important criteria. And one more important thing is you have to check the history of the company with regard to bonus issue. History of the company with regard to bonus issue. So if the company is giving a bonus on frequent basis, okay, that you have to check. If that company is like that, then you can choose the company for making your investment if you are targeting on bonus issues. Okay, so these are all the parameters you can consider for selecting the companies. And what you can do means you can use the screener website. So I think you all are familiar with the usage of the screener website. You can run a query based on these parameters and you can try to select the company. Then you can decide whether you are going to invest into that company or not. So you can also check the fundamentals. So that has been explained by the by Karthika ma'am in one of our session which has been done earlier. So you can consider all those parameters and finally you can decide whether you are going to invest into that company or not. So this is the perspective of the bonus issue. So then I'll move to another important topic which is called as taxation. So how the taxation is normally calculated for the bonus issue. So when we are coming with the taxation, so as we are from the commerce background and the management background, we have some idea about long-term capital gains and short-term capital gains. So from the year 2018, so after March 31st, 2018, all the long-term capital gains are under the tax and they have the exemption of 1 lakh rupee. So if your long-term gain is more than 1 lakh rupee, you have to pay the tax, long-term capital gain tax at 10%. So this is an important information with regard to tax. So I'm going to give you an example so that you will able to understand how we are going to calculate short-term gains with regard to bonus issue and how we are going to calculate long-term gains with regard to bonus issue. And one more important thing, if I purchased a share of Infosys, okay, if I purchased a share of Infosys in 1994, okay, and I sold that particular share 33 2018. So at that point of time, long-term capital gains are not taxable. There is no need to pay the tax. Whatever gain I'm getting, there is no need to pay the tax. Okay, so the same share. Okay, say if I you can take 1994, you bought a share of Infosys and you sold in 10 4 2018. So you have to pay 10% long-term capital gain tax for tax for long-term capital gain if your gain is more than 1 lakh rupee. Okay, so this is the another important thing. There is a concept of grandfathering. So that concept is applicable at this point of time. So government has given some restrictions or some scenarios based on that we can calculate the tax. So if it is this case, I'm not going to explain this concept as of now. So before I'm going to the example, I'm just moving it. So now I'm going to take a simple example to give you a clarity about how the tax is to be calculated for the bonus issue. Okay, so for that, you can take a company called company named as Wipro. Okay, so I'm taking this company to explain the concept of taxation in a simple manner. So please kindly follow me. So imagine that you bought yourself bought only one share in Wipro. Okay, so on only one share in Wipro on 1st November 2018. Okay, so at that point of time, the market price of the share is rupees 500. Imagine. So okay, so current market price at the time of buying. Okay, so when you bought this particular share on that day, the market price is rupees 500. Okay, so Wipro. Okay, so this company has came with the bonus issue. Okay, so bonus issue by this company on, okay, bonus issue by this company on 1st January 2019. Okay, so the bonus ratio is 1:1. Okay, 1:1. So at that point of time, okay, the current market price is rupees 600. Okay, so here we have two scenarios. Okay, so first one, you yourself entering into the market and you bought one share of Wipro on 1st November 2018. At that point of time, the current market price is 500. So you gave 500 rupees and you get a share, or you got a one share, you bought one share. Okay, so second scenario, so you are not willing to sell that particular share immediately. You would like to keep it with you for long term And this is your idea. So you have to keep that particular share, or you are thinking that the share price is going to increase. So that is the reason why you are just keeping that particular share with your demat account itself. You are not willing to sell. And as on 1st January 2019, so on this particular day, Wipro company has made an announcement stating that we are giving you the bonus share in 1:1 ratio. Okay, so at that point of time, market price is 600 rupees. Okay, so now you can say the impact of bonus issue. So already you have one share. Company says that you can take another one share from us, okay, at free of cost. Okay, so now you will have two shares. Okay, two shares. So automatically the price after bonus issue, okay, after bonus issue, the price after bonus issue will come down to rupees 300. Okay, I'll show you the formula afterwards so that you can able to understand how this is going to be calculated. Okay, so this is the this is the basic thing about the example. Okay, here I'm going to introduce another two important concepts to you. Okay, so this 600 rupees, okay, so this 600 rupees is called as, this 600 is having the term, this 600 rupees is called as thumb basis. So which means that the market price before bonus issue. Okay, market price before bonus issue. So this is cum bonus. Okay, so this 300 is called as X bonus. Okay, X bonus. So not basis, bonus. Okay, X bonus. So this is the price which is post bonus issue. Bonus issue. Okay, so these are all the two terms. Maybe you may be familiar with these two terms, but some beginners are there. This may be useful for them. Okay, and after some period of time, now you imagine that you have two shares as of now. So one share you bought. Okay, one share you bought by paying 500 rupees, and another share you got it from Wipro at free of cost. Okay, so there is no payment here. So this is for free of cost. Okay, so totally you have two shares as of now. So, and you are having an idea that the market price is going up. So if market price is going up, at that point of time, your mind is thinking that I'm just exit with this position. Okay, so the market price is moving from 300. Okay, market price is moving from 300 to 400. Okay, so you can just think after 1 year period of time or after some point of time, the market price is moving from 300 to 400. Okay, so at this point, 400 rupees at this point, 400 rupees at this point, you would like to sell the shares which you held in your demat account. Okay, you would like to sell the shares which you held in your demat account. So now taxation is coming to play. Okay, so here you have two shares. So I am just dividing it into two areas. One is for the first share. So this you bought at 500. Okay, so second second share. So this is the second one. This you got from your company Wipro at free of cost. Okay, so how the tax is going to be? Okay, so first you have a share which you bought, right? So what is your cost price? Cost price means buying price. At the time of buying, how much you paid? You paid 500 rupees. Okay, so what is the cost price for the second share? So there is no cost price, right? You have not paid anything for this. So cost price for the second one is 0 because this has been given by your company at free of cost. And you can imagine that the market price, present market price is 400, right? This is the current market price. Okay, so you bought the share at 500 and you are trying to sell it for rupees 400. Okay, here you made a loss of 100 rupees. So this is your loss. Okay, so next, second one, you are selling this particular share at rupees 400, right? 400. This is the market price. So here you made a profit of 400 rupees. Sorry, 400 rupees. Okay. So coming to the tax, for which particular amount I'm going to pay. So this is a loss. So there is no need to pay for this. So this is the profit that you have gained. So you have to pay the tax for this. So short-term capital gain tax at 15%. So 15% of this 400 will automatically rupees 60. So this you have to pay as a tax. And one more important thing I would like to clarify with you all, that why this is considered to be the short-term capital gain. Okay, I'll tell you. This is considered to be the short-term capital gain if this particular bonus share that you got it, right? So the bonus share, just I'm moving so that you will able to see the date. Okay, so here now I'll take another color. Sorry. Yes. Now here you got this particular share, second one. Okay, so this one on January 2019. Okay, January 2019. So this is going to be the short-term capital gain if you sell this before 31st December 2019. So if you are going to sell this on 1st January 2020 or after that, there is no need to pay the short-term capital gain tax at 15%. But at the same time, you have to pay the long-term capital gain tax. Long-term capital gain tax if your taxable profit, okay, thing is above 1 lakh, you have to pay 10%, or otherwise there is no need to pay. One more important thing, you have to take the date. Okay, so when you consider this one, November 2008 as the bonus share received date, so this is not actually the bonus share received date. This is the date where you bought the shares of the Wipro. So because of this, you are getting the bonus share on 1st January 2019. So if you take this one for calculating the bonus tax for the bonus issue, this is going to be the wrong. You have to take the date at which you receive the bonus share into your account. Then that is the thing that is to be taken for the calculation of the tax. Okay, so if you received a bonus share, if you are selling the bonus share after 1 year period of time, there is no need to pay the short-term capital gain tax. Instead, you have to pay the long-term capital gain tax if the taxable profit is going to be greater than 1 lakh rupee. Okay, so this is with regard to the taxation. And I already explained one important concept called grandfathering. So that is in 3 different scenarios. Okay, why now you will able to realize why this particular concept has came into picture. Okay, so now there is now you can take 2 persons. One person has bought a share of Infosys in the year 1993. Okay, and he is trying to sell that particular share before 33 2018. So at that point of time, there is no tax. There is no need to pay the long-term capital gain tax also if it is exceeding 1 lakh rupee. But and another person who has bought the share of the Infosys in the year 1993, he sold after 31st 3 2018, he needs to pay the long-term capital gain tax, that to a 10% if it is exceeding 1 lakh rupee. The profit is exceeding 1 lakh rupee. So that is the reason why, in order to give a justice to that people, or to the citizens of our government has introduced the concept called grandfathering. Okay, so they have different scenarios. Based on that, the tax is going to be less. Our tax benefit is fully given to the people of our country. Okay, so this is the important thing with regard to taxation in bonus issue. So I'm just to close this one, close my presentation, this whiteboard, and I'm again going back to the PowerPoint presentation. Okay. Here I'm just explaining some simple concepts with regard to bonus issue. So the effect of the bonus issue. Now you can able to understand each and every point clearly. So if you are able to understand the previous explanation, if you understood the previous explanations, these are the points very easy. Okay. So first important thing is increases number of outstanding equity shares. So when a company is coming up with the bonus issue, just you can think. So a company is having 20 shares. Okay, a company is coming up with the bonus issue of 1:1. Then this 20 will become 40. So that is the increase of number of outstanding equity shares. So before the bonus issue, outstanding equity shares is 20. After bonus issue, outstanding equity share is 40. So this is the effect of the bonus issue. And second one, reduces the share price in proportion to the number of bonus shares issued. So when number of shares increases, that will automatically decrease the share price. Okay, so there is a formula and there is a calculation for calculating the price of the share post bonus issue. Okay, so that we will discuss. So at that point of time, you will able to know how it is reducing the share price in proportion to that. Okay, so you can look at this formula, look at that particular formula, then you will able to realize. And third important point is free reserves and surpluses of the company. So it reduces the reserves and surplus of the company. Why it reduces the reserves and surplus of the company? When the company is coming up with the bonus issue, the fund for this bonus issue has been taken from the reserves and surplus. So that is the reason why bonus issue is reducing the reserves and surpluses, because bonus issue is at free of cost. Bonus shares is at free of cost for the investors. If a company is issuing this at free of cost, where they are funding for that? They are taking the fund from the reserves and surplus. That is the reason why this is reducing the reserves and surpluses. Next, creates implicit value of the equity share. This is again based on the assumptions of the external people. Our investors are thinking that this is going to reduce the price of the share. Okay, so that is the assumption of the people associated with that, and increase liquidity in equity shares on the stock exchanges. So it will automatically increase the liquidity. I will give you one example. Say for an example, a company is traded at 1,000 rupees. A company is traded at 1,000 rupees. So at this point of time, a retail investor who is having the amount of 50,000 rupees, okay, who is having the amount of 50,000 rupees, is not able to participate effectively on the intraday, okay, because the share price is so huge. He needs to buy less number of shares. With that, he is able to gain less number of profit. Okay, so or a person with 10,000 rupees, or a person with 10,000 rupees, he would like to do an intraday trade. So this particular share, which is having 1,000 rupees, is not that so good for him. Okay, so when a company is coming up with the bonus issue, this 1,000 will reduce based on the ratio. Say for an example, if it is 1:1, it is going to be 500. Okay, as like that, share price is coming down. So whenever price is coming down, the participation will increase. Okay, say for an example, if you take MRF, the share price of MRF is approximately 80,000. Okay, share price of MRF is approximately 80,000. If I would like to buy a share from MRF, I have to pay 80,000 rupees. Okay, this is not affordable by everyone, because retailer investors are the people, those who have invested less than 2 lakh rupee in the market and they are participating. So for them it is too high. If share price reduces, okay, if share price reduces, then this is going to be benefited. Whenever price reduces, the participation will increase. Number of shares for the daily trade will increase automatically. Okay, you can take another real-time example, IRCTC. This particular company is now traded at 2,500 rupees. So soon they are coming up with the stock split. If stock split is coming, so maybe 250 we are getting the share of that particular company. So if it is so, the participation will increase. So that is the thing they are saying that as liquidity. So whenever share price comes down, number of people buying and selling the particular share increases, that will automatically create the demand for that particular share. Whenever demand creates, that will automatically increase the price of the share. Okay, you can take each-share motor also. Okay, so on some before this corona starting in 2019, December or January, you can take, or before that you can take, it is traded above 17,000 rupees per share. So after that they came up with the share split. Now it is traded at 2,500 or 700 rupees in the market. So this is the effect of the bonus issue or share split, I can say. And it will automatically reduces the EPS and book value, etc. Because these are all the parameters which are based on the number of shares. So you can take EPS, the formula for EPS, profit after tax divided by number of outstanding shares. So in this particular point, you will able to know. So whenever a company is coming up with bonus issue, number of outstanding shares will increase. Whenever number of outstanding shares increases, that will automatically reduces the EPS. Say for an example, profit is 1 rupee. If it is divided by 1 rupee, profit is 10 rupees. If it is divided by 2, we will get 5. Okay, so profit is 10 rupees. If we divide that by 4, then it is automatically reduces 2.5, right? So that is the effect of the bonus issue. Because of increase of number of shares, that will automatically reduces the EPS, book value, etc. Okay, so these are the effects of the bonus issue. Now I'll tell you the small difference between stock split and bonus issue in a short span of time. So stock split is similar to bonus issue, but there is a difference between stock split and bonus issue. So when a company is coming up with the stock split, they are trying to reduce the face value. Okay, so the face value of 10 will become 2. Okay, so if they are reducing the face value, automatically number of shares will increase. So that is the that is called as face value, and you are knowing very well about the bonus issue, right? So this is the main difference between stock split and bonus shares. So now I'm moving to this formula. So here in the formula, you are able to see two important components. One is pre-bonus market price of the share and post-bonus number of shares. This post-bonus number of shares will be calculated based on this particular formula. So that is called as adjustment factor. So A plus B divided by B. So here they have given an example. So market price of the particular share before the bonus issue. This is pre-bonus market price. So bonus ratio 2:1. This is A, this is B. Okay, they have given, right, A bonus share for every B share held. Okay, so this is the bonus, this is the share that you have held. So 2 plus 1, 3 divided by 1, 3. Divided by 1, again you will get 3. So 15 divided by 3, you will get 5 rupees. So this is the price after completion of the issue. Okay, so and stock split. So there is a small difference between the stock split and bonus issue. The formula we have uh, adjustment factor. So in that bonus issue formula, we have the adjustment factor A plus B divided by B. So, but we have small difference in the adjustment factor, that is A divided by B. So here market price is 15 rupees, and that will be divided into 2:1. So your adjustment factor will become 2. So you will get 7.50 rupees as the price. Okay. So and these are the some information with regard to compliances. So if you are not receiving your bonus share, and if you are not receiving the dividend from your company after announcement, then you can make a complaint to registrar and transfer agent and the company. If they are not responding to it, you can also make a complaint directly to SEBI from Scores platform. Okay, so that's all from my side. So thank you for listening. So I'm just requesting Karthika ma'am to go ahead with the further topics. I'll stop my presentation here. So dear participants, if you have any queries, so please kindly put it in the chat box, or else you can ask us finally. Thank you.
Yes, thank you, Nagarajan sir. It's a well done. Sir, and also meanwhile, you can assign the host rights to me and try to present.
Ma'am,
you can just click a participant.
Yes, ma'am.
Yes.
I'll do it.
Yeah.
Okay, ma'am. Done, ma'am. You can.
Yeah, thank you, sir. Thank you. I hope my screen is visible to all.
Yes, ma'am. Visible.
Yes, sir. Yes, ma'am.
So, very good evening to all. So, I heartfully welcome you all to today's session. So, the Nagarajan sir had discussed about stock split and bonus shares. So, here I would like to discuss about dividends. So usually everyone enter into the stock market. Why? Because we need money, want to make money from our investment. So in order to do that, the first they have to understand how people making money from the so sorry. So for in order to make money in the share market, the people has to understand that how it will happen. So basically, there are the two way for making the money from the share market. One is capital appreciation, and another one is money received in the form of dividend. Yes. So I hope everybody know what is capital appreciation. So buying it is in the lower price and selling in later period for the higher price, so we are able to make a money. For example, it's like in 2 years back, IRCTC price is around, it is listed 800 rupees. I'm just speaking about listing price of the IRCTC. So today, as it's we know, it's moving in the market of market into around 2500. So one who bought these shares 2 years back at the 800 rupees, and today they are selling at 2500. Okay, it's so they can make the profit of around 1800 rupees per share. So this is what it's a capital appreciation. So buying at a low, finding the value shares, buying at the low price and selling in a later point, it's a higher price or as per the expectation price is reached. So this one way is making the money. So another way of making the money from the stock market is receiving the dividend. So the principle. So before going to discuss about the how to select the dividend providing shares, and also we want to know some of the basic terminologies regarding the dividend. So and also before that I want to note that the people, what happened all of, sorry, my screen is, I think it's not shared. Yes. So So the people always look around the capital appreciation concept, that is seeing the market and buying at low and selling it. This is a major mindset of the people, and very few people they consider about dividend. Okay, that is a secondary income in the capital market in the form of receiving the dividend, and most of the newbie, they ignored this. Okay, concentrating of the dividend. So here we will discuss it. So what are the things we should understand before selecting the dividend shares for your investment? So first, let us understand the basic of the key terminologies. Also, sir is explained about all this ex-dividend date and all. It's bonus shares and dividend. It's similar. So we have around low. So especially the dividend is nothing but it is like a portion of the company's profit is shared with their existing shareholder in the form of dividend. So usually the company earn the income. So the earnings of the company might be shared with the shareholder in the form of dividend, or the company they can keep that. That means reserve their earnings for the future purpose. For example, like they have the good opportunity to expand the business, or again they are investing into the land and building, or they are entering into the new market. So many the reason for like the firms are in the it's a startup stage, or it's like they are into the growing, the cycle of the firm. So they are growing stage. So the company they have their desire to keep of much of their earnings in the retained form. Okay, so as in India, there is no condition for the companies, they have to mandatorily pay the dividend. So usually the company they keep some part of their earnings, okay, in the form of retained earnings. Then the remaining portions they will make a dividend payment. So the dividend payout, so usually like 30:70. 30 is a dividend payout ratio, or 70% of the retained earnings the company desire to keep it with them as a resource. So for the further investment. So this ratio also will differ. There is no card and thumb rule. Each company they have this much of a dividend payout ratio. It's not like that. Okay. So for example, it is if we are the investor, so we are planning to invest into the dividend paying company shares. So we will concentrate of the companies which are keeping the 40% as a dividend payout ratio. That means in their earnings, 40% they are distributing to the shareholder in the form of dividend. The remaining 60 they are keeping themselves for the further expenses. So here, when we speak about the dividend, the two terminologies, the company announced in the dividend in the two forms. One is interim dividend, another one is final dividend. So interim dividend is very the interim dividend is payment is made by the company before the preparation of their final financial statement. Usually before ending of that particular financial year, the company they decide the interim dividend. So which are the company usually they do? They are that means they provide interim dividends. Means we are companies who are all having much reserves and surpluses. Okay, the company are keeping much reserves and surpluses, like you can see Hindustan Zinc or like these companies. So who are all it's keeping their reserves and surpluses, or the money is more in this account. So that company they disclose or they are distribute interim dividend. And the final dividend is nothing but is the dividend is declared by the company by having the mutual discussion with the board, and after preparation of the final financial statement. Okay, so that means final dividend is declared based upon that particular year earnings, but interim dividend is declared some amount is taken from their reserves and surplus account. That amount is distributed as the interim dividend with the existing shareholder. Yes. So one example I would like to explain, so that will give you the clarity. So how one should uh, 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 get know about the dividend and how one should get benefited by investing in dividend stocks. For example, before that, so look at that, these are the some companies, okay, they provide the dividend. So dividend, it might be in terms of interim dividend or in terms of personal dividend. So very recent companies names I displayed here. So the dividend percentage, okay, so it's arranged from lowest percentage to highest percentage. So we can take the company name Britannia. So Britannia interim dividend is, okay, it's a 6,200 point percentage. So what is this 6,200 point? So this 6,200 point is the percentage on the face value. So the percentage on the face value. So suppose if we take Britannia shares face value is rupees 10 means, so 6,200 percentage on rupees 10. So like that, this dividend percentage will help you. So one more example, if because very recently, okay, it is like ITC. So ITC, they given a dividend of, okay, 1,015 percentage on 6/7/2020. So I like last month. So they declared the dividend of 1,015 1,015 percentage. So how much share we can get it? So like it is on face value. For example, that face value is 10 means, so we can get it rupees 10, okay, 10 paise 15 per share. Okay. So for example, if you are holder of the 100 shares of the ITC company, so what will be your approximate dividend? So 100 shares means also nearly you can get it, dividend is 1,150 rupees. Okay, so this is 10.15 rupees per share. So if you are the holder of ITC shares of 100 shares, so 100 into 10 rupees or 10.15 rupees, so almost we can get it like this. Okay, it's 1,150 rupees. So these dividend percentages are announced on its face value. So so that as I told, the dividend may be announced in the form of final or in the form of interim dividend also. So just have a look at that. Whenever that so usually the interim dividends, so all it's here. Interim dividends value, the percentage is little higher than the final dividend. Yes. So here I just want to note down few key parameters and information regarding the dividend. So first, declaration date. The declaration date is nothing but it is the date where the board is approved for distribution of the dividend. So the record date is the date as on record date who are the existing shareholder of the company. Okay, so those people are getting the eligibility for receive the dividend. So here there is a minimum 5 days gap between the declaration date and the dividend date. Come dividend date. So come dividend date, for example, the company is announced, declared the dividend. So the news is released in the market. So the investor, by seeing that, then they are taking the decision of buying the particular company shares. Then they should buy the shares, okay, before the come dividend date. Okay, that is 1 day prior to the ex dividend date. So those who are okay, so ex dividend date is a date after that or on ex dividend day. If somebody are planning to purchase the particular shares, by knowing that the company is declared a dividend, then they are not eligible for receiving the dividend. So that is what so we should very careful. If we are the buyer, that means buying that intention of take benefit the dividend. So we should buy the company shares, okay, before come dividend date at least, okay, on the come dividend date. So that is what its prediction. And payment date, usually it is announced by the company, okay, that is the payment of the dividend to the existing shareholders to be completed within 30 days, where they can got from the approval. So these are all the key things we should understand. Apart from that, we should know that how the dividend announcement, its impact to the share price of the company in the post dividend period. So for example, the rupees 2 rupees per share is as a dividend is announced by the company, means in the post dividend period. So what will be the market price of the shares? So this dividend of 2 rupees usually adjusted with the market share price. So the market share price of ex dividend date, that is meant post dividend date, it's definitely will reduced. So why in the sense means people are not get benefited, because you, as I told, no, after the ex dividend date, who are the buyer of that particular shares, definitely they are not received that. So this impact also, it's due to that the share price will go down. So usually after the announcement of the dividend, okay, the post dividend date, that is ex dividend date, market share price will move down. Yes. So now we have to go with how one should make money through investing in dividend paying stocks. So first, once we are thinking about investing into the dividend paying stocks, we should concentrate the parameter of dividend yield. So the dividend yield is very easy. There is an annual dividend, okay, provided by the company per share in related to the market price. So it's for example, so the company, they provide they are providing the annual dividend, okay, is in the form of either indirium or final together, put together rupees 10 per share. So the current market price of the share is rupees 200. So what is the dividend yield? So dividend yield is nothing but, so 10 rupees per share is the entire dividend. So so we will receive per year, and it's suppose the moving price, the current price of the particular share in the market is rupees 200, means so our dividend yield is 5%. So we have keep the criteria to select the company, okay, to invest our money, the dividend yields as a one of the criteria. So the dividend yields, which are the company, they are providing the dividend yield is more than 3%. So we just put it into the watch list. We will watch it. So what are the companies, they are providing the dividend yield more than 3% in a year? So we can screen out the companies in that criteria basis. For one example, so, and the people don't think that you will make more money in the form of dividend, or you will make a quick money in the form of dividend. That is very, very difficult. Look at that. If the person suppose invested into the particular share in the year one, so that time the share price is 200. Okay, so he got 5%. Okay, so he got 5% of the yield. For if suppose he is holding of 100 shares, sorry. So he is holding 100 shares. So so what is that year? It is a total dividend income, that is rupees 1,000. So like year two, the company is providing the dividend. It's like 12 rupees. So that year, okay, that is the dividend yield is 6%. So that year income of the person is 1,200. It's year three. That time it's the company is providing the dividend yield some 7.5%. Its income would be like 1,500. So fourth year 18 rupees. It's like dividend yield is 9. So this table gives you the understanding So we should always consider the company, which company's dividend yield is consistent over a period of time and also it's increasing. And and we can't say, for example, so our household expenses is per year is like for 1 lakh rupees. The expense. So I'm just spending, putting the around like 10 to 12,000, 10,000 per year, 10,000 per month is the expenses of our household expenses. We want to earn that 10,000 rupees, 10,000 rupees in the form of dividend to invest in the SAF. It's not at all possible. So in that case, we want to invest in 1 crore rupees. Is it possible by the investor? No. So the dividend income is some additional income, okay, invested by the investor, as well as the capital appreciation. So here we have to understand what is the benefit. You are keeping that particular company shares for the longer period. So what is happening year on year there is an income and as well as the capital appreciation. So look at that. In the year one, the investor they valued that particular stock and purchased at the rupees 200. The company is growing good, so their dividend yield also it's consistently increasing. The time of fifth year, the share might be 500 rupees. For an example, so here the dual benefit is the year on year there is some income, okay, as well as the capital appreciation is happening over the period of time. So this is way the dividend investor they have to take it the benefit. They don't expect that much more return in the form of dividend. Definitely that is not possible. Yeah, coming to the taxation. So again, I want to give to that it's a taxation. The people who are investing in that stock dividend company and for the dividend what they are received up to March 2020, the dividend income or tax exempted. So look at that, up to March 2020, it was tax exempted. So now it is whatever the dividend income, okay, that is taxable as per the individual tax slab. So that is what it is in terms of tax part. So this income is taxable. Yes. Next, if somebody they are planning to select the company, okay, for investing their money, their aim is to want to park their money. Which are the companies they are providing the good dividend? So how to select the company? So I will show you that, okay, how one should select the company which are providing the good dividend over the period of time. Again, I'm just moving to the screener website, okay, to show you. So how to we have to filter the companies which is providing. So as of now we discussed we should give. So if you are planning to screen out the companies which is providing the more dividend, the first criteria, keep it the dividend payout ratio is 40 and as a filtering criteria, and keep it as a dividend yield is a 3%. And again, these the rule, ROE and ROC is the same. We already discussed that, okay. So more than 20% of both, and as well as the market cap. So don't go with the small cap companies. So very okay. So at least go with the market cap. So it's like more than 2,000 or 5,000 crore up. So like here I would like to go with the screen of I'm just copying the query and moving to the screen. Screener.in. So I in the Google type screener.in, go to the website www.screener.in, and there you can go to screen. So create a screen. So that asks you to you have to log in it. So you create an account or using with your Google account also you can able to log in. Yes. So after that, again, click the screen option and create a new screen. There, so as we discussed, the two criteria, one is dividend payout ratio. So look at that dividend payout ratio. It's um, more than 40% for past 3 years. So dividend payout rate and dividend yields, which is more than 4%. Again, market capitalization. So we are given just 1,000 or we can keep it 2,000. It's based upon your expectation. Don't click the button of so only those companies where recent quarter result is available. So if you click that option, the screener filtering only the company's recent quarter result. So we don't want, we want the past year histories. So we didn't click that. So just run the queries. So that after that, it will give out all the list of companies which is coming under your criteria. So look at that. There are 15 companies. Okay, it is got by your screener website. So almost market capitalization. This is 10,000 crore. Okay, so all companies above, because filtering we given above 2,002 crore market capitalization for our filtering. So here what you do, you just go with one by one companies or which companies we are planning to. The first company, I just want go with that very low price. So this is for, look at that, because if you are investing in the shares which you are planning to see that the share, okay, the value stock which is has the lower value, that means like it's a buying price is very less, only 20. See, look at that, all out of this almost is above 100 rupees. Something that I found, it is very interestingly, these two companies, NHPC and SJNV, the current market price is a very less, 27.15 paise. So what, just I selected that company for knowing further. Okay. So here here you just look at that. Market capitalization is 10,000 crore. Current market price is 27 rupees. The book value. So this is an undervalued share because so that's current market price is lower than that book value, but in the market you find that okay, most of the companies, we can say 80% of the companies shares are currently trading at the market, which is more okay, more than that book value. But this companies, it's undervalued itself, and ROC we expect 20%. Okay, this is a government sector, it is power sector, electricity generating company. It's a, you know, it's a, for the company information, you just able to click here. Okay, the here it is hydropower project, and you want to know who is this company and who is the promoter. Okay, this is in government, so it's a promoted by the government of India. Okay, where it is located, it's a Himachal Pradesh. So like that, you can able to see all the companies, the who are the top client, what are the project, as ongoing now, the total capacity is ongoing project, under construction project, all the details about the company you can able to trace out here. So what are the new project the company is going to undertake in upcoming years? So all this information is available. Yes. So right the way you can able to find out the high dividend paying companies. So after that you are see that anything is and you can also see that debt to equity ratio. So we already know that debt to equity, if any ratios are not there, you just click that edit option, then type the ratio, it will be added in your screen. So debt to equity ratio is also, it's 0.1%, is quite okay. So the company is it's not has that much of debt liability burden. So you can look at the price movement also in the past 4 years, from maximum of, yeah, the companies is available from May to, it's from 21 to as of now, there is no much fluctuation. It's there only, it's a 24, it's now itself it's a 27. So what it is makes in that there is no good capital gain, because you can look at the past 10 years, the share prices are 24. Now it's also, it's like 28 somehow it's the most highest point is 33. So this is a maximum up and low prices over the 2010 to now in the 10 years. So we can come to know, yes, though the company's share prices is less, the company is paying the dividend, the capital gain, opportunity for capital gain, this is very low in this company. So this is what we can and understand. And coming to the comparison of peer comparison, you can understand, check that almost this, as I told, that is a electricity generating company. Almost all the companies' share prices are up. This is current market size is low, and see, book to earning price, we already discussed that this should be always low. That is a good for the value investment. It should be less than 15. But here you can find out the peer comparison. Almost 4 or 5 companies PE ratio is more than 15. So, but the few companies we can able to see NDPC, SNB, or these companies book to earning ratio is low. This is also, it's one of the good point. So you can go on down and see the profit and loss account and balance sheet, know about the company's reserves. Yes, company's reserves are keep on increasing. Okay, in P&L account, you see the net profit, whether the net profit, yes, net profit is okay, but it is not that much of growth in the net profit. Almost from 2013 to 2021, it's a net profit it's the same range. And but the only, because we filter the company with the major consideration with the dividend payout, but you can look at the dividend payout, it's a quite good. But coming to the sales growth and coming to the net profit growth, it's not that much of growth is recorded in this shares. So like that, you can come to the conclusion and go to, again you can go to main screen. Yeah, so you can go to main screen and select some other company. So I came up again the out, so the 15 company lists are there. You can just select some other company to know about information. So here so I just selected Hindustan Zinc Limited. You can find out what is that company, what is their market position. So 77% of the total zinc and mining activities are done by the Hindustan Zinc Limited only. So they are almost, they are their good market share among the peers. So they are globally. So they are not only performing in Indian level. So their existence is there in the global level. So just go through the key points about the company information. After that, you go with the yes. See the capital appreciation. So the maximum capital appreciation, like over the 5 years of period. Look at that. See 2000. So this company is also, it's like around 200 5 years back share. So now it is it's like 300. Yes, 5 years 5 years down the price. So 5 year down the time, how much is the shares growth happen? It's a per share, it is 100 rupees is increase. So that you have just capital appreciation, or you can just click here. You want to know that the return. So return, you can return over 5 years period. Okay. So written over the 5 years period, you can able to find out how the companies performed, what is the return they given the last 5 years. So written over 3 years period, you can able to give that ratio here also. You can able to find out what is the company's return over the previous year. Yes. So coming to the here, yeah. So the dividend payout ratio. So the company is providing the dividend payout ratio as 107.14. Yes, that is a good comparing to in terms of dividend payments. But in terms of capital appreciation, I told you, no, so 5 years, what is the price in so 5 years, the price is 100 rupees per share is increased. So you maximum, you can just, if you are okay, keeping for the longer period, if it is like 15 years or from 2010 year down the line, 2010 or 11 onwards, like 120, now it's 300. Yes, it is for, okay, it's a capital 150 rupees, the capital gain per share has happened like down the line 10 years period. So here, as an investor, you have to see the two terms. One is how these companies' capital appreciation is going on. and as well as the dividend. So both you can consider, and which you find which companies find it's a quite good. And so find out that these companies, why that's so much of dividends means, look at the reserves. The company's reserves, okay, it's a huge company. Its reserves is huge. It's a more than their fixed asset. You can look at that reserves and the fixed asset. The reserves of the company is very huge, more than the fixed asset. So that company is providing the interim dividend. So good interim dividend. So their dividend payout ratio is more than 100%. So like that, we use the screener website, okay, to find out the good company which suitable based upon your aim. So aim of the investor in the dividend paying stock is the both capital appreciation and as well as well as well as as well as the some regular income. So please the dividend, so as I'm just repeating that we won't get good benefit over the short term period for the dividend. So we have to find out the values value investing stock, keep investing and keep it for 10 to 15 a longer period, so the dividend and as well as the capital appreciation will help. So one should when to exit, okay, so they have to end with the investment in the dividend stock means whenever dividend, okay, dividends, the companies paying dividends start declining. So whenever the dividend is declining, and whenever the companies are high payout, so high payout also it's not good. Why I'm saying high payout, in the sense if the company is paying so high dividend payout, it's like payout ratio, companies pay okay, payout ratio is like 80%. So what it says that 80% of the company's income earnings are distributed in the form of the dividend means so it shows that the company don't, okay, doesn't have further opportunity to grow. So the capital appreciation of the shares will be at the stake. So we have to consider that. And policy dividend, the company very frequently they are changing the dividend policy. In terms of dividend, they are changing the dividend policy. Definitely that we should not keep that kind of shares for in the motive of receiving the dividend. So these are all the few parameters we should take care while putting our money into the dividend paying stock. So our aim is not only that fixed, that means regular income, not a fixed income, regular income from the investment. The capital appreciation also important. So this is what I would like to end with this session. The session is open for the queries. So dear participant, kindly raise a question.
Good evening to you, madam.
Yes, sir.
Thank you,
Good evening,
madam,
sir.
for very nice seminars given by you and sir. Both of you gave very well explanation about especially that how do you check the company growth and dividend bonus and how it will be, and how to use screener. That is also very nice. Thanks, madam, for your both of you.
Thank you, sir. Thank you.
Thank you, sir.
Thank you, sir.
Dear participant, kindly post your queries in the chat box. Thank you, Ramdev sir. Ramdev sir is posted no question because understood.
Good evening, ma'am. This
Yes,
is
sir.
Nishant.
Good evening.
This is
Yes, sir.
Nishant.
Yeah.
Excellent explanation, ma'am, regarding that screener website and regarding the dividends. I have one general question, ma'am.
Yes, sir.
what I am doing, my personal experience I am asking. I want to know whether I am going the right path or I am doing something wrong.
And also, we are very eager to receive the question from you, Nissan sir.
Okay, ma'am. Actually, for past around 7 to 8 months, I am investing in shares, ma'am. What I am
Okay.
doing is, I will see for top 15 companies in the Nifty. Then
Okay.
I will select 10 to 12 companies of different sectors in the top 15.
Good.
Oh, and monthly I can able to save around 5,000 rupees. That 5,000 rupees I just split it in different companies based on the amount, not based on the number of shares. Based on the amount, I will buy 1 or 2 shares. Like that I am doing, ma'am. For past 7 months I am doing. Whether this and also for every quarters I will see the results of that particular company what I have invested. And in that way I am doing, ma'am. If I follow the same procedure for next 5 or 10 years, whether I'll have the benefit of compounding or whether it is the correct way of investment.
I will share my perspective and I ask from Nagarajan sir also. Sir, that means top 15 companies. I hope all blue chip companies because you are from Nifty. Okay,
Yes,
you
ma'am.
are. So it's whenever this is a safe side. I'm just tell you this is a safe side you are doing. The method is not a wrong. But if you want to enjoy the high benefit means you have to find out the company. It's like we can keep find out the good company in the small scale and park that money into that small scale company. If you keep into that longer period, that will give you amazing return, but risk also will high. So the for example, we don't know, okay, in 1980s, so what would be the performance of Wipro? What would be the performance of this Infosys and all in those periods? But we are seeing these are all the big chain now. So if we have to enjoy the more benefit means first we should tick and find the companies. Now it is in like it is a small cap companies, but there is a future demand for that companies are in the market. So you find it like small coin like that, and you also try for that. If you are that is not performing well in future period, then you revise your portfolio. So that is my it's one suggestion. What about Nagarajan sir?
Yes, ma'am. Sir, so I also have some ideas. So what you are doing is presently right, because you have selected top 50 companies in the Nifty and you are trying to select different sectors, companies from different sector. That is good. But what you can do is you can check on your portfolio on yearly basis. So say for an example, you can take a standard, that is a cutoff rate. Say for an example, each and every year your portfolio is going to grow at 10%. So if your portfolio is not growing more than that, you have to check all the companies that you have selected, whether those companies are yield the proper return or giving you the proper return or not. If any of the company is not giving you the proper return, and you can check the future perspective of that company also. If you think that the company is not going to grow in future, at that point of time you can eliminate that company from your portfolio and you can take another company which is having good future perspective. So as like that you can maintain your portfolio, sir. This is one important thing. And before selecting the company, you cannot go with the only one criteria like 50 companies from different sector as like that. Instead, what you can do is you can always check the valuation. You can check the company's share which is in undervalued. So a company share which is overvalued, that will be the trouble for you when the company is not performing well in days to come. So you have to check the company's fundamentals. If you find that the fundamentals of the companies are good, then you can select the company from a different sector. So this is the suggestion I'm having for you, sir. So hope you are also getting some idea about using the screener website. It is a great source for you at free of cost. So what you can do is you can use the screener and you can try to filter out the stocks which are in undervalue, and you can also check that whether the company is performing well in future based on the sales growth and other criteria which has been already explained by Karthika ma'am clearly. So based on that, you can select and you can revise your portfolio. So this is my opinion. And also nowadays there is a concept called small case. So this is one platform we have for the investment. You can also go through it. And if you find that it is too suitable to you, you can also explore it, sir. That way you can do. So this is my opinion, sir.
Thank you so much, sir. Excellent insights. That 10 percentage and what ma'am told, even that small case also we can easily find using screeners. Actually, I heard about screener, but regarding that formula and all today, ma'am clearly explained. So thank you so much, ma'am, and thank you so much, sir.
Thank you, sir.
Thank you, sir.
Participants can post their questions in the chat box or unmute yourselves and ask the questions directly. Are there any questions? Ma'am, sir, can we wind up?
Yes, ma'am. It's
Yes,
not
ma'am.
an issue. I'm just waiting on 1 or 2 questions from the participants.
Even we are expecting few questions. Ma'am, a few of them were asking for the PPTs. Would that be available?
Yes, ma'am. Yes, I will share that all the PPTs what we discussed at
Okay, ma'am. Okay, we would put that in the group, Telegram group for them to take it.
Yes, definitely, ma'am. Sure.
Okay, ma'am. Thank you. And as I see, there are no more questions.
Hello,
and
madam.
yes,
The screener, there is 2 options there. One is called the new user login. Another one is called the. There are 2 options there. Which one we have to select? New
Sir,
login
first
or-
you can log in into that is the best. If you once you log in into your account, no sir. If whatever you are editing, whatever the ratios we frequently you want to see, all that whenever you are logging into your account, or if whichever company you are selecting, all that ratios will come in front of you. So better first you log in. So by creating account or log in with your Google account with the screener.com, that is possible.
Okay.
Okay. So once all your favorable ratios is stored forever, if you are login and doing that. Without login, you are directly using the screener website. Each and every time you have to modify it as per your need.
Okay.
Yes, sir.
Okay.
Yes.
Thanks.
Thank you, sir. Thank you.
more questions?
Yes.
Question in the chat box, ma'am. Any standard is there for that? Nishant sir is asking.
Nishant sir, standard in the sense for what, sir? Okay, what is there is as for the warden Buffett, it is the 15 to 20 companies is the ideal size of the portfolio, but we can it's like customized based upon our investment amount and like that. It's a minimum normally for the beginners. The 10 companies I will suggest for the beginners. It's usually if you go with it's a big personalities like the father of investments, what they are saying, it's 50 to 20 shares in a company. It's an ideal portfolio.
Ma'am, sir, one more important thing. So these are the informations which I and Karthik ma'am shared you is very basic. So when you have an interest to know about the portfolio and all, please kindly go and surf on the internet. There are various models available for constructing the portfolio. So what you can do means you can filter out the companies based on some criteria, and you can take the data of those companies for the past 5 years or 10 years, and you can put it in the portfolio construction models which are available. Then you will get the amount which you have to invested in each and every company that you have selected. Say for an example, based on the criteria, you have selected 10 companies. So you can put it all those 10 companies data into a model. That model will filter out, and that model is telling you you have to invest this much of amount in this particular company. As like that, that model is giving you an idea. And afterwards, you have to check whether the company is yielding a sufficient return. So if it is not like that, you can exclude that company and you can include another company, and you can reconstruct the model. As like that, you can do revisions. So there is a model available for constructing the portfolio. So you can use that model effectively. That will definitely help you to manage your portfolio and construct your portfolio well. So this is, if you are interested, you can also go ahead. Yes, ma'am.
Sir, you are discussing like the mark-wise RP and all to do for this portfolio, or
Yes,
some
ma'am.
other. Yes, okay. Actually, we done it a long back. That is what again I'm recalling.
Yes, ma'am.
But I hope now there is a online portal also. It will be there for consulting, because it's, if we do like that, it's consume lot of time for the investors to do that. To check that portfolio. That is what it's. I'm just thinking over it. So how now these fintech companies now developed to made us to do the fundamental analysis very easy. So we have to check that it is how the portfolio or valuation to be done, like by using either any or online platform. It's
Yes.
our own.
So,
Yes.
and one more thing, we can also do with the help of Excel. Instead of using the different formulas, there is a matrix formula which is available. So based on the matrices, we can able to construct the portfolio. So Nishan sir, if it is possible, you can try to explore. There are many videos available in YouTube to construct the portfolio by using Excel. So that will be definitely helpful to you to construct your portfolio appropriately.
Thank you, sir. Thank you, sir. Surely I will look after that. Wonderful learning today, sir. Thank you so much.
Thank you, sir.
Yes. Thank you, sir. Thank you, everyone. So I hope there is no further more question.
Right, ma'am. I'm just searching the chat box. Yeah, there are no more questions. Only the feedbacks have been given that it was a wonderful session.
So
right, we'll go ahead.
We will end. Yes, sir.
Yes, ma'am. We'll go ahead with the. Would like to thank our resource persons. As I've already mentioned, we don't have words to thank you formally every day. We're doing it formally, but by our hearts, we're really thankful. Our department is thankful that this is happening, and so many people have been getting benefits out of it. And I really hope that this will definitely lead us to, start investing in stock market and do the things ahead. Fine. So on behalf of the IQAC and the PG Department and Research Center in Commerce, Rajapalayam Rajus College, I would like to thank our resource persons for today, that is Nagarajan sir and Karthika ma'am, who had handled the topics like bonus shares and stock split, which was given. I really thank Nagarajan sir. It was really clear-cut information on bonus shares. Sometimes we always feel that when we buy shares in the beginning of the company's growth, we buy it, and later on, after 10 or 15 years, like you gave example of Infosys, it only increases because of the rate of interest or because of the share prices has been increased. But bonus shares, really, we got the clear-cut idea as to why people really do get benefits out of it. And stock split, of course. And then Karthika ma'am taught us about the dividends. And then Screener website would be really helpful to find out which company will be giving us more dividends or what kind of dividends we want, and then we can select the companies. We really thank you, both of you, for this. I thank the participants for their patience and their participation. Thank you so much. Thank you.
Thank you, ma'am.
Thank you.